Good day, everyone. I am Apple Angel Humangon from Group 2. Our group will be discussing the financial statement analysis of fraud. So to begin with, let me discuss first the main objective and the other objectives of this topic. The main objective of analysis financial statement for the company is to provide unnecessary information which is required by the users of financial statement. For um, for the informative decision making, assessing the current and past performance of the company, predicting of the success or failure of the business. So we come up with the four objectives of financial statement analysis. The first one is to know the current position of the company. So promoters or owners want to know whether the company is heading to the right direction or they are lagging in their target, which they have planned in the past. Regular recording of financial transactions help them to understand the financial position and help them analyze prospect in a better way. So, for example, the revenue data of ABC company for the last 4 years. So, suppose the company had previously planned to double its revenues over the next 5 years. So, they have revenue data of the company for the last 4 years. As you can see, the company is performing very well in the first 2 years and looks like it will reach the desired target or maybe perform better than their desired target. But in the previous year of 2018 to 2019, the revenue growth of the company declined to single digit, around 6% on a revenue basis. So the decline in revenue will be a cause of concern for the management, but will be able to gear up their team in time to work more efficiently to reach their target. Objective 2, eliminating discrepancies, if any. Recording of day-to-day transactions, examples, sales and purchases, expenses or incomes, or other statement help them understand where they need to improve or make decision in case of any discrepancies. So example, suppose a company has target sales of 1,500 in this financial year. The quarterly sales report shows sales of just 300 in the first quarter. Each month during the first 3 months, the revenue numbers are increasing, but that there was a consistent decline. So as you can see in the month of July to September, it consistently declined. Maintaining each month's revenue will help the management to get engaged with the sales team and find out the reasons for the fall in revenue numbers. Eliminating discrepancies and will act accordingly to stop the dip in revenue numbers and try to reach their target as planned. Objective 3 is future decision making. So I have here an example. As you can see, quarterly statement like sales book, purchases, trading accounts, or manufacturing accounts help them executing their plans in a better way. This provide this provides them the opportunity to make future decisions with reliable information. There are new practice of um, pre- preparing professional financial accounts, even in small companies. Analyzing financial statement on a short-term basis helps the organization to make efficient decision. So, in my example, suppose the company operating margin is around 12 to 13% for the 7 to 8 quarters. But the previous quarters, the operating margin drops significantly to 7.1%. The company is performing well on the revenue front, but more precisely, maintaining the operating margin at the consistent level with an increase in the sales number. But the quarter ending June 19, the operating margin dips to 7%, which is way below the average of 12 to 13%, which the company is managing over the last 5 to 6 quarters. There may be many reasons for the fall in the operating margin, like increase in a raw material, a decrease in sales price due to demand, or decrease in direct expenses like wages or electricity, and the company after reviewing it. So after reviewing it, we'll need to change the future strategy and make some decision depending upon the reason for the fall in operating margin in the last quarter. So maybe kung ning taas ilahang expenses like electricity, so depende na nila kung unsaon nila. So there are strategies nga ilahang buhaton. So financial statement help to understand the reason and make future decision depending on the situation. So it's assumed the reason is decreasing in sales price. Management can take the necessary steps to understand the future market sentiments and identify the reason for the decrease in the sales price, and can optimize for a strategy according to each situation. So objective for the last objective is minimizing the chance of fraud. Um, so many of us expect that minimize the chance of fraud is the main objective, but it's wrong. This is not the main objective of analyzing transaction, but the one which cannot be neglected. Often we come across the news that the employees cheated his boss. So kadaghan na ta kadungog ani nga ang mga accountant ani ka sa nana chu. So which lead a huge losses for the company. Analyzing the statement will make sure that the employee will be aware, that the management is aware of everything that is happening in the company, and also if any suspicion arises on any financial entry, management can make a look into the matter and will be able to solve it without incurring losses or extra losses. So, example, commission given by the accounts department to the agent of the company, or there is a difference in purchase raw materials. Since the company records is maintained on individual accounts of each suppliers, they can analyze each account which will lead to the conclusion that the company will not have to suffer losses due to the fraud done by one of his employees. Another examples, there is a surge in the conveyances. So as you can see, the highlighted one, conveyance expenses and general expenses of the firm. More than threefold increases in the expenses are a case of suspicion, and management would want to have a look at the butcher and verify who has to pay it, receive it, and for what purpose. So in conclusion, financial statements are important for all stakeholders, especially the investors. Investors need to analyze the financial statement before making an investment in the company. Lisod naman sab og mo invest sila nga kanang nga company dili profitable dayon naa pa jay issues, di ba? Same way, banks will be more comfortable in granting loans to these companies whose financial books are well maintained and shows a clear picture of their profits. This makes them more confident that the company will be able to pay future debt obligation. So, makalong sila ha ang company. Next. So, this is as- now the short view of this topic. Evaluating financial statement using ratio. Wait. So the rest of the topic will be discussed with my other group mates. So this is a short view. Ratio analysis compares line data from the company's financial statement to reveal insight regarding profitability, liquidity, operational efficiency, and solvency. Um, Ratio analysis is a quantitative method of gaining insight. So ratio analysis can mark how company is performing over time while comparing a company to another within the same industry or sector. While ratios offer useful insight into a company, they should be paired with other metrics to obtain a broader picture of a company's financial health. So the other subtopic of ratio analysis are evaluating liquidity, evaluating probability, evaluating long-term solvency, evaluating cash flows adequacy, and evaluating market ratios will be discussed by my other group mates. So thank you.
Hello everyone, I am Rachel. In continuation to our report, I will be discussing about evaluating liquidity. To begin with, let us first define what is liquidity means. Liquidity refers to the ability of business to pay its obligations in cash as they mature. Therefore, the focal point of liquidity analysis is cash, wherein it includes the ability of the management to convert its current assets into cash in a quick, stable, and regular manner. Hence, liquidity is important for learning how easily a company can pay off its short-term liabilities and debts. Basically, there are 6 different categories of ratios: the liquidity ratios, activity ratios, leverage ratios, profitability ratios, growth ratios, and valuation ratios. But since my only task is to discuss about evaluating liquidity, therefore I will be focusing more in the first and second category. The first category ratio is liquidity ratios. Liquidity ratios measure the ability of a company to meet its short-term obligations. The following are liquidity ratios: the current ratio and the acid test ratio. And let us know first the current ratio. Current ratio is equal to current assets over current liabilities. This ratio measures the company's ability to pay its current liabilities with its current assets. Accordingly, if current assets is greater than current liabilities, then ratio is greater than 1.0 is a desirable situation to be in. If current assets is equal to current liabilities, then ratio is equal to 1.0 is current assets are just enough to pay down the short-term obligations. For example, current assets is equal to 6,945,000, current liabilities is equal to 5,787,500, and a current ratio is equal to 1.2. This means that the business has 2 times more current assets than liabilities to cover its debts. Because a current ratio below 1 means that the company doesn't have enough liquid assets to cover its short-term liabilities. Acid test ratio or quick ratio is equal to current assets minus inventory over current liabilities. This ratio measures the company's ability to pay its short-term debt with its liquid assets. For example, current assets minus inventory is equal to 5,620,000, current liabilities is equal to 3,750,000, and a quick ratio is equal to 1.50. This means that the business has enough quick assets to pay its current liabilities, because the higher the ratio result, the better a company's liquidity and financial health. The lower the ratio, the more likely the company will struggle with paying debts. So again, based on this example, the business has enough quick assets to pay its current liabilities. The second category ratio is activity ratios. Activity ratios measure how effectively a company uses its assets. The following are activity ratios: the accounts receivable turnover and inventory turnover. But then again, let us know first what is accounts receivable turnover. Accounts receivable turnover is equal to net credit sales over average accounts receivable. This ratio measures the company's ability to pay its short-term debt with its liquid assets. It measures the number of times the receivable base is used in a given period. For example, net credit sales is equal to 500,000. Average accounts receivable is equal to 50,000. Accounts receivable turnover is equal to 10 times. This means that the company's account receivable are turning over 10 times per year. Thus, the higher the turnover, the better, and the more effective the management is in using company's resources, because it indicates that the company's collection of account receivable is efficient, and that the company has a high proportion of quality customers that pay their debts quickly. Last but not the least, inventory turnover. Inventory turnover is equal to cost of goods sold over average inventory. This ratio measures how quickly inventory is sold. For example, cost of sales is equal to 13,465,000, average inventory is equal to 1,325,000, and the inventory turnover is equal to 10.2 times. This means that the company's inventory has been sold strong sales. Thus, the higher the turnover, the shorter the conversion period, the shorter the operating cycle, and the more liquid the business will be. Because then again, the higher the inventory turnover, the better. Since high inventory turnover typically means a company is selling goods quickly and there is considerable demand for their products. Low inventory turnover, on the other hand, would like indicate weaker sales and declining demand for a company's product. So that ends my report and thank you for listening.
Evaluating profitability. Return on sales. Return on sales is a ratio used to evaluate a company's operational efficiency. This measure provides insight into how much profit is being produced per dollar of sales. An increasing ROS indicates that a company is growing more efficiently, while our decreasing ROS could signal impending financial troubles. ROS is very closely related to a firm's operating profit margin. Formula: ROS is equal to net sales divided by operating profit, where ROS is equal to return on sales. Operating profit is calculated as earnings before interest, or EBIT. When calculating return on sales, investors might notice that some companies report net sales while others report revenue. Net sales is total revenue minus the credits or refund paid to customers for merchandise return. Net sales will likely be listed for companies in the retail industry, while others will list revenue. Below are the steps to calculate return on sales. First, locate net sales on the income statement, but it can also be listed as revenue. Second, locate operating profit on the income statement. Be sure not to include non-operating activities and expenses, such as taxes and interest expenses. Third, divide operating profit by net sales. Return on total assets. The return on total asset ratio indicates how well a company's investment generate value, making it an important measure of productivity for a business. It is calculated by dividing the company's earnings after tax by its total assets and multiplying the result by 100%. We have here the example. If ABC Corporation has earnings after tax of $20,000 and total asset of $300,000, its return on total assets ratio will be $20,000 divided by $300,000 times 100% is equal to 6.7%. As general rule, the higher the percentage, the better. Business owners and other analysts will usually want to compare the return on total assets ratio for a specific company with others in the same industry to get a true picture of how well the company or business is performing. Return on equity. Return on equity express the percentage of net income related to stockholders' equity, or the rate of return on the money that equity investors have put into the business. The ROE ratio is one that is particularly watched by stock analysts and investors. A favorably high ROE ratio is often cited as a reason to purchase a company's stocks. Companies with a high return on equity are usually more capable of generating cash internally and therefore less independent on debt financing.
So good morning, guys. Good morning, Sir Pai. So our my task is to discuss the evaluating long-term solvency under the analyzing financial statement fraud, which is the debt ratio, time interest earned ratio. So the solvency ratio examines a company's ability to meet its long-term obligations. This ratio is most often used by prospective lenders when evaluating a company's creditworthiness. A higher ratio percentage result indicates a company's increased ability to cover its liabilities cover the long term. So these are the following ratios used to determine organizations' long-term solvency. First, debt ratio. The debt ratio is a financial ratio that measures the extent of a company's leverage. The debt ratio is defined as the ratio of total debt to total assets, or debt to asset ratio. Expressed as a decimal or percentage, it can be interpreted as the proportion of companies' assets that are financed by debt, and total debt to total equity or debt to equity ratio. It is measure of the degree to which a company is financing its operation through debt versus wholly owned funds. And the last is time interest earned ratio, and measure a company's ability to meet its debt obligation based on its current income. The formula for a company's time interest and ratio number is earnings before interest and taxes divided by the total interest payable on bonds and other debt. So next, let's proceed to the calculation of debt ratio and time interest earned. So first, the debt to asset ratio calculation. So as you can see, I used Pepsi Corporation Inc. balance sheet December 25, 2010 and December 26, 2009. But we will use the year 2010. So as you can see that this is dollar. But note the dollar is in million. So these are the formula of the debt to asset ratio. So total liabilities divided by the total assets. So these are the liabilities. $4,898,000,000, which is the short-term obligations, and plus $10,923,000,000, which is the accounts payable and other liabilities, plus the $71 million, which is the income taxes payable, plus the long-term debt, which is the $19,999,000,000, plus $10,786,000,000, which is the other liabilities and deferred taxes, divided by the total assets, which is the $668,153,000,000. So the result ratio is 0.68 cent. So it tells us that in every dollars in asset, Pepsi has 68 cents in liabilities. So next, debt to equity ratio calculation. So these are the formula is total liabilities over total shareholder equity. So the same, I use PepsiCo Corporation Inc. balance sheet. So these are the total liabilities. The same 46, the total of $46,677,000,000, and over the total shareholders equity, which is 21,476,000,000. These are the 4,558,000,000, which is the common stock, plus the 37,402,000,000, the return earnings, and minus the preferred stock, which is 109 billion, and minus 3,630,000,000, which is the accumulated income, and minus the treasury stock, which is 16,745,000,000. And the result is 21,476,000,000. So 46,607,000,000 total liabilities divided by $21,476,000,000 total shareholder equities, and the result is 2.17 to 1 ratio. So it tells us that every dollars in shareholders equity, Pepsi has $2 in total liabilities. So every dollar shareholder equity, they've got just a little over $2 in debt. So they leveraged a bit. So they leverage the company a bit. Oftentimes, this is referred to as they leverage their equity basically to an amount of 2 to 1. 2 to 1. And some would argue that the higher that numbers goes, the more risk the company is of defaulting on its debt. So the last issue that we were going to discuss is time interest earned ratio calculation. So this is the formula: net income plus income tax expense plus interest expense over or divided by interest expense. So the same, I use PepsiCo and INC income statement. So these are the income. So this is the income, which is $6,322,000,000, and the income tax expense, which is $1,894,000,000 plus $903,000,000. The interest expense divided by the extra expense, again $903,000,000. So the total net income plus income tax expense plus interest expense is $9,117,000,000 over 903, which is $1,000,000, which is the interest expense. The equal, and the result is the ratio of 10.09 times. So it tells us that they can pay their interest expense of a little amount 10 times of their interest. So the times it just earned ratio is 10.09 times. So that's all, sir, guys, and thank you. Bye.
Hello, my topic is evaluating cash flow adequacy. I'm Melicor Maureen. So first, what is cash flow adequacy ratio? Cash flow adequacy ratio determines whether the cash flow generated by the operation of a business are sufficient to pay ongoing expenses. So this cash flow adequacy ratio is used by the investor to understand how well the business can cover its payments, which is a good indicator of its future performance capabilities. Principally, adequacy ratio is liquidity ratio because it measures the ability of a corporation to meet its cash out flow requirement from investment and financing activities using cash flows from operation. The formula of cash flow adequacy ratio is cash flow operation divided by long-term DIP paid plus fixed asset purchase plus cash dividend distributed. For example, a business generate 500,000 of cash flow from operation in its most recent year of operation. During that time, it also paid down 225,000 of debts, acquired 175,000 of fixed assets, and paid out 75,000 of dividends. So by using the formula we just only to substitute it into the formula, so we will get a cash flow adequacy of 1.01. So therefore any higher than 1 is indicate that the business was able to meet its financial obligation, and the lesser the ratio could be indicate that the business will face uncertainty for future capabilities. So that's for the cash flow adequacy ratio. Next is cash flow liquidity ratio. So liquidity ratio is used to evaluate and measure company's ability to meet the demands for cash as they arise. Liquidity ratio measures a company's ability to pay DIP's obligation. This is important to determine a debtor's ability to pay off current debt obligation without raising external capital and determine if a company have the ability to cover short-term obligation and cash flow. And examples of cash liquidity ratio rather is a current ratio, quick ratio, asset test ratio, or it is also known, quick ratio is also known as asset test ratio, and net working capital, cash ratio. This example of liquidity ratio are been discussed by my group mates. The formula on finding the liquidity ratio is cash plus cash equivalent plus marketable securities plus cash flow from operating activities divided current liabilities. The greater than 1 means the greater than 1 ratio means short-term obligation are fully covered, and it is also indicate that the business is in a good financial status and less likely to fail in the business environment. Next is defensive interval ratio. Defensive interval ratio is a financial metric that indicates the number of days that a company can operate without needing to access non-current assets. So this defensive interval ratio are more useful daw than the quick ratio and current ratio, as it compares asset to actual expenses than liabilities. Though this interval ratio number is preferred, there is no specific number that indicate what is right or better to aim for. This ratio is called defensive ratio because it in calculation it involves a company's current assets, which also known defensive assets, that consist of cash equivalent, or other investment that be readily converted to cash, such as account receivable. The formula for defensive interval ratio is defensive interval ratio equals current assets divided daily operation expense, where current asset is cash plus marketable securities plus net receivable, and daily operating expenses or annual operation expenses minus non-cash charge, then divided 365 days or 360 days. Example is, suppose that the company currently has 40,000 in cash, 10,000 in account receivable, and 20,000 worth of available for sale securities. The company has 300,000 and inquires 25,000 in annual depreciation. What is annual depreciation? What is its defensive interval ratio? So by using the formula we got of defensive interval ratio, we can have a DIR of 92.9 days, which this indicates that the higher DIR is considered good, as not only does it show that the company can rely on its own finances, but it also provides a company enough time to evaluate other meaningful options in paying its expenses. So by that, the defensive interval does not provide significant context about the company's situation. The ratio should be compared to the DIR of a DIR companies in the same industry in order to gain insight. As such, this ratios has its limitation, and as an investor, you have to be see first the financial statement of the business that you wanted to invest for, to make a full analysis before deciding whether to invest. And that would be all. Thank you.
So, today, I'll be the one to discuss to you about evaluating market ratios. Why is it important for us to know about market ratios? Do we really need to know it? So first, before we answer that question, let us know what is the definition of market ratios. Market ratios help evaluate the economic status of publicly traded companies and can play a role in identifying stocks that may be overvalued, undervalued, or priced fairly. So, market value ratios are important for investors, management, and etc. because these ratios are used to decide whether the valuation of the shares are overvalued, undervalued, or at par with the market. These ratios are used for making investment decisions in stock of companies. In investments of stocks, there are various financial metrics which are used to properly evaluate the prices of the shares so that the investment doesn't go in vain. The decision of buying and selling shares is very important, and if not done at the right price, then the money invested can be wasted. So market value ratios analysis is very crucial to share market investment as well as other investments and for company management as well. So these are the different market value ratios used by the share market investors. So first, let's have the earnings per share. So earnings per share is an important financial measure which indicates the profitability of a company. Earnings per share measures a company net income of outstanding stock, indicating a company's profitability and to investors. So to calculate earnings per share, divide the company's net income by the number of outstanding shares. For example, if a company has 10 million in net income and 4 million outstanding shares, the earnings per share would be 10 million by 4 million, which amounts to 2.50. So the earnings per share is equals to 2.50. So next, let's have the book value per share. Literally means the value of a business according to its book that is reflected through its financial statements. So this ratio is again one of the most important market value ratios to analyze and decide whether the price per share of the company is at its market price or not. This ratio shows the relation between the book value of the company. So take note, the equity, total equity excluding the preferred stock of the shareholders, and the outstanding shares in the market. So it can be calculated as equity divided by the shares outstanding in the market. So, for example, if the company's total assets equals to 15 million and its total liabilities equals to 5 million, so 15 million minus 5 million, then the total equity would be 10 million. So if the company has 2 million in preferred stock, deduct that to get the 8 million. The amount available to common shareholders, if there are 1 million outstanding shares, the book value per share would be 8 or 8 million divided by million. So therefore, the book value per share of the company is equal to 8. So next is the market per share. Represents the value of the company according to the stock market. This is the ratio which is obtained by dividing the total market of the shares of the company by the number of the shares which are outstanding. So for example, the XYZ company has a total market of 25 million and 1 million outstanding shares. So 25 million divided by 1 million, the market value per share is 25 pesos. So next, let's have the market or book ratio. So market to book ratio. Analysts can compare a company's market value to its book value. The market to book ratio is typically used by investors to show the market's perception of particular stock's value. It is used to value insurance and financial companies, real estate, and investment trusts. So this ratio can be calculated by dividing the market value per share by the book value per share. So for example, if a company has a book value per share of 8 and the stock currently valued 10 per share, the MB ratio would be calculated by dividing 10, the stock price, by 8, the book value per share. So this would give you a ratio of 1.25. So the market to book ratio is 1.25. Next is the price-earnings ratio. The price-earnings ratio is the current price of the stock divided by the earnings per share. PE ratios are used by investors and analysts to determine the relative value of a company's shares in an apples-to-apples comparison. It can also be used to compare a company against its own historical record or to compare aggregate markets against one another over time. For example, if a stock is trading at 25 pesos per share and its earnings per share are 2.50, the PE ratio would be 25 pesos divided by 2.50, which equals a ratio of 10 pesos. So, the price-earnings ratio is equals to 10. So, now, let's move to price or cash ratio. This ratio compares the price of company stock to its cash flow. To calculate this ratio, simply divide the market value of a share by the amount of cash flow per share. So, for example, if the price of a company's stock is 20 per share and the company has a cash flow of 10 per share, the cash price ratio would be 20 divided by 10, which equals to 2. So, the price or cash ratio is equals to 2. And the last one is the dividend yield ratio. So, the dividend yield, expressed as a percentage, is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. Analysts arrive at the dividend yield ratio by dividing the total dividend payments paid per year by the market price of the stock. So, for example, if the company pays out dividends quarterly in amounts of 2.25, 2.50, 2.50 in the third quarter, and 2.75 in the fourth quarter, the total dividend payments for the year would be 10 pesos. If the price of the stock is 100, you would divide 10 by 100, so the answer is 0.10 or 10% every year. So now we conclude that market ratios are very important for investors and managements because it is the basis for their decision making in investment. So that's all. Thank you.